So look, I'm going to say something that could be a little bit provocative. Why are you wasting your time trying to find the best investment vehicle when obviously the best and least complex one with ETFs are around for years, making a lot of smart people rich? We will go over the 5 best monthly dividend ETFs for your investment right now and the coming years ahead. So, you heard right, monthly dividends, not per year or quarterly. You will get a passive cash flow once a month, which is the easiest way to create your first passive income. Now, after a long research, I picked out 5 of the best ones in my opinion that will take you to the next level to get financial independent, especially with a very low risk. And the best part of it is, it takes absolutely no knowledge to get started because I'm here for you, and after this value pack video, you're gonna leave with clear instructions which ETFs are right for you, and I'm gonna promise you, you will be much smarter and also richer after this video. Number 5 on the list is SPHD or Invesco S&P 500 Low Volatility ETF, which was formed in 2012 and is based in the US. And as the name implies, it seeks to track the performance of the S&P 500 Low Volatility High Dividend Index by using a full replication technique. Oh yes, that was long. In other words, you don't have to do the hustle to find stocks that are below average volatility and stocks which pay above average dividends. So basically, this ETF does everything for you. And as you know, S&P 500 consists of 500 large cap companies traded on the American Stock Exchange. And to ensure the low volatility of this ETF, SPHD holds only 50 of the least volatile and highest yielding names from it. For example, in order to achieve this goal, SPHD tends to be heavy on utility stocks, which basically provides services like electricity, natural gas, or stocks for everyday use like Kinder Morgan in the energy industry, or Altria Group, who sells smokables and oral tobacco products. And the list goes on with a couple more well-known companies like AT&T, Philip Morris, and or Chevron Corporation. And of course, low volatility implies also that SPHD is light on fast-growing tech companies which are or could be more volatile. Now, you would think because of the low volatility, we will have a low yearly return on our investment, but that's not true. With investing in SPHD, you will have an average annual total return of 10.65% in the past 10 years. So this means if you would have invested in SPHD 10 years ago, your investment of $10,000 would have grown to almost $28,000. And that's not even the ETF which grown the most in our list. We will go over the other ones in a second. But that's not everything. Besides the value appreciation of this ETF, you could also decide to use the current impressive yield of 4%, currently sitting on 3.82%, to generate passive income monthly. And yes, I know 4% doesn't sound that appealing to you, but in my opinion it should be, because for example, starting with the crisis in 2020, we currently are in a market environment of high inflation and rising interest rates, which could probably last in 2023 and beyond. As you can see, this ETF has outperformed the S&P 500 by far in 2022. And that's not a surprise because high dividend strategies are very popular during high inflation and rising interest rates. Basically, the purpose of such an ETF is that investors, or better said, the owners, are not stressed out because of their investment and can sleep well at night. Now, coming to my conclusion, we have to talk about the expense ratio for holding this ETF and how healthy the dividend growth is and what we can expect from it in the future. Regarding the expense ratio, everything below 0.75% is reasonable, but better be under 0.5%, and SPHD with 0.3% can be named as cheap, where you would have to pay $30 per year on an investment of $10,000. The dividend growth looks also pretty solid, temporarily being reduced 2 times in the past 2 years, where 2021 is an obvious one coming just out of the crisis in 2022. So those 2 dividend reductions can be seen as a risk for the future, but are nothing to be concerned of in my opinion. Generally speaking, the whole point of this dividend ETF is to reduce risk and spread your source of dividend income to less risky sectors and stocks, which is okay though. If you want to have a less risky ETF in your portfolio with a steady income, then SPHD could be the right for you, but that's only number 5 on our list, with better yields and higher total returns ETFs still to be discussed. So the next one is Noble or ProShares S&P 500 Dividend Aristocrats ETF, founded in 2013. Now, somebody thought about the name for a long time. With aristocrats in the naming, we could be thinking about them. Makes sense because a aristocrat is someone, for example, whose family has a high social rank or a title. Generally speaking, this ETF consists of aristocrat stocks which are very stable, well known, and are having a pile of cash on the sides, meaning endless cash flow. Basically, Noble invests in stocks of companies operating across diversified sectors which invest in growth and value stocks of large cap companies. Alright, this ETF will be always compared to the next one in our list, which is the more riskier one, but later more to that. Noble, as I said, is a safe bet for people who are seeking for a more traditional long-term dividend growth vehicle, but you will be surprised about the price appreciation of Noble and the dividend yield. Because to be positioned in the Noble stock portfolio, the dividend company must have increased their annual dividend every year for at least 25 consecutive years. That's worth an aristocrat, because companies that hit the 25-year mark are generally more mature in the nature and come from industries which saw steady demand throughout all market cycles, like all kind of bear markets or also bull markets. And also one big criteria which will block stocks entering Noble is not having enough cash flow or not being a revenue generator, which is important to be a part of a aristocrat stock. Speaking about the stocks, here is a breakdown of the sectors of Noble, with one single sector not allowed to comprise more than 30% of the index weight. As you can see, Noble is overweight in some of the traditional, or better said, stodgier sectors like industrials with over 20%, which could be stocks of construction equipment companies, transportation or industrial machinery, and a lot more. And also a big part of the portfolio goes to consumer defensive with more than 20%, like companies engaged in the manufacturing of food, beverages, households and personal products. So you get it. You have companies in the portfolio of Noble which probably will never be not trending, like WW Graininger, which offers 3 million customers things like lighting, plumbing tools, safety supplies and a lot more. Or number 5 in our list with ExxonMobil Corp, I think oil and gas corporations will be still trending a very long time. Okay, everything is very promising, but how does that look like on our chart with $10,000 invested? Since Noble's inception in 2013, we face an average annual total return of 12.5%, which will bring us only in 9 years closely to a total value of $29,000 from our initial investment of $10,000, which is amazing. And not to forget about the annual dividend yield of 1.92%, which is, to be honest, not that as big as I want to have it, but still amazing with the value appreciation of this ETF. A good rule of thumb is that a good dividend yield should be somewhere between 2 and 5%, but be careful. You could also have more than 10 or even 50% annual dividend yield, but the value of your investment could decline significantly over time, which in the end lead to a loss of your total investment. And there's a name for it, value trap, which I will explain a little later with the next ETF, how that scenario can look like and how you can avoid it. Going forward, the expense ratio of Noble is around 0.35%, which means $35 on a $10,000 investment per year. Just looking at the dividend growth chart, we can see that besides 2 small drops in dividends, especially the dividend growth in 2021 after the crisis in 2020, is just crazy and shows how strong the base pillars from Noble are, which makes it the perfect investment for the coming years. But also the next ETF in our list, which will be often compared to Noble, will for sure make you a millionaire way before retirement. I will show you how in a second. Alright, number 3 on our list, we have to talk about WIG, or better known as Vanguard Dividend Appreciation ETF, which seeks to track the performance of the S&P 500 US Dividend Growers Index. In other words, WIG tracks the performance of the companies within the S&P 500 that have increased their dividends over time. Basically, what it does for you is it picks out the companies that have increased their dividends for at least 10 years, so different to Noble with the 25 years. And what WIG does here with the lower 10 years requirement is to open the door to emerging long-term dividend growers. So it can still include names which you will find also in Noble, but due to the 10-year growth requirement from WIG, you will find younger and more growth-oriented, well-known companies like Microsoft and Visa, which have raised their dividends for 17 and 13 years, which in my opinion are amazing companies to be invested in. Plus, I have to tell you about one feature, or better said, a criteria of WIG, which I really like and which prevent us from getting into a value trap. So the value trap I promised to explain a couple of minutes ago. And this is that WIG excludes the top 25 highest yielding companies of the S&P 500, which helps to eliminate stocks that have unsustainable payout ratios, like for example Devon Group, which is an independent energy company. As you can see, we have an unbelievable dividend yield of almost 8%, which seems to be perfect in the first glance, but digging deeper, you can see that the stock price was losing almost all of its value starting from 2008 to 2020, and also dividend growth over the past years were not sustainable and decreasing significantly over time. And of course, because at the moment we have a high demand for energy and gas, the dividend yield skyrockets, but WIG excludes such companies out of his portfolio, which is totally fine for me. Now, talked a lot about the features, let's get speed behind this ETF. The top 10 holdings includes a giant tech company like Microsoft, financial titan JP Morgan Chase, also healthcare companies like Johnson & Johnson, United Health Group, and a lot more well-known companies like Visa, Home Depot, or Comcast. Over the past 10 years, WIG has returned an amazing average annual yield about 12.5%, which will bring us to a total of $35,000 on the investment of $10,000 10 years ago. Looking at the value appreciation of this ETF will let us feel more comfortable about the bit undersized dividend yield of 1.8%, which should be not a deal breaker for the future investors. Okay, quick interruption for our $1 million calculation with this specific ETF. To be able to make $1 million with just doing nothing sounds too good to be true, right? But with an annual return of 12.5% of WIG, this will be possible. Just imagine you are 25 years old, you invest $10,000 into this ETF and add $200 every week out of your paycheck to it. So an additional $800 saved per month going into your investment. So looking at the chart, by the age of just 45, you will be a millionaire by just doing nothing. So let's think about it. Going forward, the expense ratio of this passively managed ETF is just 0.06%, which would be $6 on a $10,000 investment, which is nothing. And dividends, amazing. Look at the healthy growth and especially the big pop just after the crisis hit us in 2020. I would say VIC has done a good job so far, meaning the combination of a reliable dividend and limited volatility is something every investor wants to see. But that's not even the one in our list with the most return. You will be surprised. Number 2 in our list can be the perfect ETF for a crisis. So looking at the past couple of years, I would say always. Being honest with you, the next one is really a game changer in a stagflational environment. We'll explain the term stagflation in a second. DHS or WisdomTree US High Dividend Fund was formed back in 2016, and as its name implies, the $1.3 billion heavyweight DHS focuses on high dividend yielding companies. So overall, what it does for you is a lot. Explanation will follow. I said the perfect ETF for a crisis like a stagflation, which basically is stagnation of the economy and inflation. In other words, the economy is shrinking, unemployment is increasing, and the demand for the new iPhones are falling. Okay, that's just a joke. This will never happen. People would, I guess, rather not eat to buy the new iPhones. But I also have one. And of course, with inflation, the prices for almost everything is rising. And exactly in this kind of environment, the ETF from DHS is your friend. Why? Because 2 points. DHS considers momentum when selecting stocks companies. What it does is to screen all dividend paying companies for high quality stocks with positive momentum. And once a few are selected, they are compared regarding their projected cash dividend over the next year, which should help to maximize yield despite the market conditions. Generally speaking, DHS isn't yield weighted, or better said, it does not prioritize companies or stocks which has the biggest yields. Rather, it is dividend weighted, which provides investors with a more accurate sense of what dividend payouts will look like going forward. And secondly, portfolio sector exposure. It matters because the best performing sectors during stagflation have historically been utilities, energy and staples, and the worst ones, tech and communication services. Looking at the holdings, DHS allocates almost 60% of its weight to energy, healthcare, and consumer staples, which explains the high dividend yield of 3.2%. Within the holdings of DHS, you will find again well-known companies like ExxonMobil, Coca-Cola, Pfizer in the healthcare industry, Verizon, and a lot more. Alright, a lot of information, but how many bucks will be in your pocket? Let's bring the facts. Looking at the last year, S&P 500 is down by around 10% and DHS 16% in plus. That's a difference of 26%. Let's translate that now in dollars with a $10,000 investment. DHS has an annual average yield about 10.63%, means that $10,000 invested 10 years ago would be worth around $29,000 today. Expense ratio runs around 0.38%, which will make $38 on a $10,000 investment. On the other side, dividend growth health is as expected, steady and increasing over the past 10 years, with obviously a small decrease in 2021 because of the crisis in 2020. Okay, for safety first investors, DHS is definitely a ETF worth considering if you think that slow economic growth in the next years and persistently high inflation will be still around. And in that case, an investment to high dividend paying ETFs could be the solution. And lastly, number 1 in our list of the best ETFs to invest right now, which brings us unbelievable gains, is SCHD, or the Schwab US Dividend Equity ETF. This ETF seeks to track the performance of the Dow Jones US Dividend 100 Index, which is designed to measure the performance of high dividend yielding stocks. So what it does for you is that SCHD consists of stocks which have a record of consistently paying dividends, are selected due to their fundamental strength against their competitors, and are based on financial ratios like the company's overall financial status. Generally speaking, you don't have to scroll through all balance sheets from the companies to exclude bad stocks within this ETF. It does everything for you. And all of this can be seen in the results. SCHD outperformed the S&P 500 by a lot. Looking at the past 5 years, S&P 500 had a total return of 68% and SCHD 84%. Looking at the holdings, we can see a unique blend of different sectors like industrials and consumer staples, which are good investments in a crisis like a stagflation, and also growth sectors like technology or communication for going with the trend, or better said, the momentum. With closely above 100 stocks, we can see as is #1 holding a name you likely won't recognize with Merck & Co., which is a global healthcare company trying to tackle the greatest health threats, but also well-known companies like Pepsi, Cisco, Pfizer, and Coca-Cola. Tracking the performance of SCHD, the current 10-year average is about 13.42%, which is the highest in our list today, resulting in an unbelievable total of $38,000 with a 10-year investment and the starting point of $10,000. Looking at the expense ratio, we have a 0.06%, basically $6 on a $10,000 investment per year, which is also amazing considering a high dividend yield of 3.14%. Plus, this is the only ETF in our list with not even one decrease in dividends over the past 10 years. Just looking at the last 4 years, the dividend just pops up despite of the crisis we have. Now, going back to our fictional goal of $250,000 in 10 years, you have to just start with $10,000 and a contribution to your investment of $200 per week, and you will have a bit more than $250,000 in 10 years, plain and easy. SCHD, in my opinion, is the perfect blend of quality dividend growth stocks with the perfect risk ratio, high yield, and high value appreciation over time. Alright, if you are in your early 20s or even in your 30s, it is definitely not too late to invest in ETFs to get financial free very early in your life. As I showed you before, you can easily reach $1 million within 20 years or $250,000 in 10 years, or a lot earlier if you have a good paycheck, where you can live off just from the dividends of your ETFs. You will not believe it, but a lot of people are just living from their investments a couple of years ago. At least they can pay a lot of bills with it. Looking back to our SCHG investment with a 12.5% annual return and a 3.14% yield, in just 20 years with a weekly contribution of $200, you will reach $1 million. 3.14% out of $1 million are around $31,000. Divided by 12, you will have a monthly passive income with dividends of $2,600, minus taxes, of course, but that's unbelievable. Your $1 million will still gain in value and you can just use the dividends for whatever you like. So I hope I could give you a good overview about the ETFs and how you can make money out of it. In case you found some value out of this video and did not smash the like button yet, now is the right time for it. It would really mean a lot to me. Also hit the notification bell and subscribe to my channel. Thanks a lot for sticking around and see you in the next one.